pick your brain. What's the secret to angel investing? What's your secret to angel investing? So I'll throw some questions at you, but would love to first do a very quick intro of you for our wider community, and please correct me where I go wrong or add to it. But as far as I know, you've worked on both sides, the good and the bad. You've built up a couple of VC funds. One is Overkill, other is Superangel, which is the latter especially is one of our favorite BADideas.fund VC born out of Estonia. And in terms of track record, you've invested in 40 plus startups through that role. But besides that, you are also building up Whimsical as part of the team, which is a 30 million funded startup or scale up by Index.
By Axel, but yes.
Oh, Axel.
Well, for you, not for me, right?
My bad. But please add to it. Is that the correct assessment? And on top of that,
absolutely.
you are doing actively angel investing. Crazy.
Yeah, I've spent my first 5 years of my career joining VC funds, both Overkill and Superangel. Was very lucky to be in the teams with both funds, and now I moved to the other side of the table in the people ops role at Whimsical. Sounds correct, and I mean, I'm so excited to be part of BADideas as well, and flex that angel investing muscle with you guys, because I think you're a very talented and exciting crowd. So yeah, let's get right to it.
I'll return the same, because every time you are on our investment committee calls, oh my God, every time you say something, it's like to the point. And so I was really looking forward to getting some of your wisdom on how you approach angel investing. So let's go get into it. Why startups as an asset class? Why do you choose to invest in startups as opposed to real estate or anywhere else?
I think everybody invests in where they have some kind of knowledge in, and I don't disregard other asset classes. I think they're equally and even more important, but definitely angel investing in startups is something that's particularly exciting for me because of my background. More specifically, I think it's just a very interesting form of education, if you will. I don't do like too extensive tickets or anything, but whenever I choose to join a startup team, I think it's adds up to my understanding of how the particular business operates and how I can help them. So I look at it as something that enriches me at first, and then hopefully I haven't done exits or anything just yet, so I can't speak on the quality of my investment thesis, but definitely that's something that enriches your perspective on what the future of tech looks like. So that's my main, if you can say, motivation or interest in it.
Okay, and just to be clear, you've done 40 investments with the hat of a VC. Now you are doing angel investing, and how many have you done already? Is that through BADideas.fund only or elsewhere? And how do you see this two worlds different now that you start formulating your own strategy?
I think investing in a fund is definitely much different than you're investing personally, because you're also looking at the value add you can bring personally rather than the fund, which is the team essentially. So it's very different strategies, and also portfolio composition strategies. I think for angel investment, I haven't been too long in the game. I just started investing with you guys at BADideas. I did one deal last year, looking to do 2 or 3 deals this year, just looking for the ones. I'm particularly excited in B2B SaaS space. That's something maybe I'm personally interested in because of my work background, and somewhere where I can add value to.
So what's your goal with angel investing? Wealth building or exposure to new?
Yeah, I don't want to break it down to anybody, but I think focusing on wealth building with startups is a risky strategy. I think the returns are just so abnormal that it takes a really large investment portfolio to get to a point where it can result into meaningful wealth creation. And definitely, like speaking from one person who did one deal last year, that's definitely not a wealth creation strategy. I look at it as an education strategy, and then just strengthening my footprint in the ecosystem and growing this portfolio over time. I think wealth building is definitely reserved to maybe other asset classes. I think startups should be viewed as opportunistic investments that can, of course, result into very large and successful exits, but it's also a function of sheer size of your portfolio. I wouldn't expect that to happen of a portfolio of size of 1 or 2 or even 5. Yeah.
To break that apart, so what you're saying, in other words, if you do just a few deals per year, you shouldn't think of angel investing as a wealth building strategy. But on the other hand, if you wanted to approach it purely as such, otherwise, yeah, you wouldn't put your own money into it if you didn't expect that this would like generate you potentially great rewards. So for a new angel investor, if they think of it as wealth building, it sounds like you would nudge them in the direction of, hey, do many bets rather than a few handful per year, or no.
No, I think you're right. I mean, look, I look at it as from my VC background, and I've screened hundreds of deals in the past. So that's why I take the road of selecting the one I really believe in and not breaking that down. However, I think if you approach it from a perspective of building wealth, I think diversification is important, and you can't build a diversified portfolio of just a handful of deals. I mean, like a rule of thumb, like typically you'd have 9 failures out of 10 startups you'd invest in, and then one would bring some return. So, and I mean, it's not a universal truth as well, right? But it's just something to calibrate your expectations that, okay, now I'm so excited about the startup, I'll do this deal, and then I'll expect something to happen, but it's very probable it's not going to happen. So I think the calibration of expectations is important here. If I were a first-time investor and just wanted to explore asset class of startups, I think there are 2 ways how you can do it. It's either allocating some kind of an capital and breaking that down into, I want to do like 10 deals this year, very small amounts, just really get my foot in the door into all deals that BADideas.fund is doing, for instance, shameless shout out, and just not diversifying across like all verticals, every deal I get to, but maybe with smaller amounts. The other strategy, can't speak of how successful either one of them is. It's a personal kind of, it depends on the personal background, but still, take that larger chunk of money, split it in maybe 2-3 deals you can clearly see that matches your investment thesis. If you have any of these beliefs, I don't know, you believe in the future of AI, you think that that's where the biggest, most successful companies in the next decade will be built, and you invest only in AI companies that are coming from the Baltic or Northern European region, for instance. I think having this thesis of, I have this vertical I believe in and I want to support it, I think that's the way to go. And whether that's how to what degree it's diversified, that's definitely for everybody to choose. But I think that's the 2 key approaches. It's either take them by mass or verticalize, specialize in some sort of verticals that you particularly believe in.
So about mistakes, you've certainly done mistakes, otherwise we don't learn. What have been yours and what have you learned from that?
I think I've done, I mean, I look at my anti-portfolio or things I've written off or we haven't invested in, and like, well, that speaks for itself. And I think
painful topic.
Yeah, I think the thing with mistakes is that in hindsight, and it's so difficult to replicate them looking back, because again, it's only one dot in the matrix from your past. So I think my core mistake really is just overlooking some founders or technologies or dismissing the potential of it. I think the key thing, and that's why I'm excited about people or recruitment or HR is that investing is a lot like hiring for something, right? You want to hire the best founders for the job, and the job is building a very successful company. And how do you screen for these things? Like, how do you screen the founding team that they have, what it takes, that they have the resilience, the grit, the market experience, the funding, the ability to get the funding, and all these things to get this job done? I definitely overlooked the importance of the founder in that grand scheme of things. I remember when I was right out of my first job at a startup. I joined VC, and I remember I had this scorecard. Okay, this is B2B SaaS, good. It's coming from the region we're investing, good. And then you get to a call and you talk about all these technology and other elements of it, but you don't even get into the depths of why the people are building this. And in early stage, that's everything. How coachable are the founders? How much do they get into? How much can they change their mind essentially, and then pivot if they need to? I think early stage investing is much more art than science, and kind of breaking down that art element into how do you get to learn the people who are building the business in a very short time. I think that's what is the most difficult part of it.
So you're talking about the challenges of evaluating, right? Spotting good teams.
For sure. And having a good scorecard criteria or anything for it. I think it's so easy. I mean, look, whenever you see somebody doing a second time startup and you think that for their first time thing was remotely successful, you'll always go and we should put the money in these people. But it's the classic second time founder bias that there was a stat that the second time founders are even much more likely to fail than rather than not, because they are, in the eyes of VCs, they have this bias of doing this, scoring it one time, and they also have this bias that they've done it successfully one time, so copying that probably will work. In some cases it might, but in some cases it won't. So there are a lot of these biases internally that you have to really understand while you're making these investment decisions.
What about, so that's evaluating. What about getting access to the deals themselves? I suppose that has been a factor when it comes to VC investing, is how important it is, and how would you suggest new angel investors to get access to good deals?
Yeah, well, I think network in this case is everything, right? Like how much you you get the quality of deals that you get access to, and if you're good enough, most probably some people will come to you and ask for the money from you, but that's not always the case, especially for new investors. How do you really get the deal flow, right? I think it's getting in the right networks. Again, that's why I think what you guys at Bad Ideas are doing is incredible, because you need to bring these people together and actually get them talking into the same room, that we're doing these deals together. I know this person who's interested in this, and help foster these connections between investors. Getting inside those hot deals is completely a network game, especially in such a small market like Baltics. Everybody's all over the hot deals that are on the market. They're getting competitive. Founders are dictating the terms. The deals that are not kind of hot on the market, they get dragged, and investors are losing interest over time. It's also an art from a founder perspective to create this sense of the train is leaving the station and investors should hop on right now. But for an investor to build any kind of good deal scouting mechanisms, it's important to work on your network and talk to founders, expose yourself into the markets, maybe do some thought leadership on LinkedIn or Twitter or anywhere where people are hanging around, and just get yourself out there that you know something about the topic and eventually also willing to invest.
So plug yourself into a network first, and then if you decide you want to allocate capacity to it, you can start building your own brand, right?
I think so. I mean, I think the best way how to get to know a startup is really help them at first, get to know the team, and then if you are convinced that this is a good deal, and not even a good deal, good team, I think that's where you have enough conviction that this is a good deal to invest in.
Okay. Awesome. But talking about hot deals, do you see that those that are really, really hard to get, that you have great VCs jumping on it and are very, very competitive, do you see that those end up being great deals to invest in?
I mean, it depends on the deal, right? Like, what is the what are the fundamentals why the deal is hot? Like, is it because it's an interesting team who are working on a very interesting problem to solve, and there's definitely some market to it? Is it just overhyped because some of the VCs really want to bump the valuation? I think it all boils down to fundamentals. But if there are some of these criteria, like good market to operate, a team that's strong, I think if the fundamentals are there, and if there's enough people excited about it, and if they can generate that hype among investors, probably they can sell. Probably they can do a lot of things that will be required of them. And I think that's a good indicator of the founding team if they can generate this sense of train leaving the station, of this deal being hot.
Got it.